Ryan Bakey, welcome to the Patryk Real Estate Show. This is something I've actually been really looking forward to. I had a whole lineup of people that I wanted to come on. And Ryan, I will be honest, you were definitely up on the top. And that might be a slight bias because you are Chicago born. For the people that don't know Ryan Bakey, it's Ryan Bakey, by the way, everybody. So that's not Bake, not Beethoven, not whatever you want to call it. It's Ryan Bakey. Just so people know and people are clear, because a lot of people screw that up. Ryan Bakey is a total genius when it comes to short-term rentals, when it comes to taxes within short-term rentals, taxes in real estate in general. He's the go-to guy when it comes to all of that. And not only that, he's also a lot younger than a lot of people think he is. He's 25 now, right, Ryan? 24. Yeah, 24 years old. But when you talk to him, you think, wow, this guy's so sharp. How is he even 24? But that's a long-winded way of explaining who Ryan Bakey is. Welcome to the show. Nice.
I'm happy to be here. Happy to be here.
Awesome. So a lot of people, and I was telling Ryan this before the show started, a lot of people really go into, Ryan, what should I do with my taxes? Or what should I do here? Or what? But a lot of times people don't focus on what Ryan's stories is. So I really want to dive a little bit more into that and really understanding, how did Ryan come about? How did he become the go-to guy for short-term rentals? And what inspired him to really dive into such a niche of a space?
Mm-hmm.
So Ryan, can you tell us a little bit about yourself and your upbringing?
Yeah, I played a lot of sports my entire life through high school and through college. Went to college, didn't really know what I wanted to do for a major. And my advisor said, hey, here's a list. Accounting was the first one on the list, and I picked it. And that's how I hear. No, I'm just kidding. So I was always good at math, mental math, fractions, division, multiplication, addition, but I was terrible at trigonometry. But I took my first accounting class in high school and everything clicked. Even though I had a B- or maybe even a C, everything clicked for me. And I knew accounting was what I wanted to do based on the projected salaries, the income potential, the opportunities, etc. And I knew even if I wanted to pivot out of the accounting space, having that knowledge would just make me a better business person, knowing how to read financial statements. And when I got to college, I majored in accounting and finance. And once I was able to combine accounting and finance with also my Excel knowledge, Microsoft Excel, it just went up from there. I was able to do time value money formulas. I was able to do discounted cash flows in Excel. Once I combined those two, it was game over. And then I eventually threw real estate into the mix. And then it just got on a whole nother level. When I was in college, the primary goal I had was to work at a Big Four accounting firm. And I went to a very small college. So to make it to a Big Four, coming from a school where we only had 4 accounting majors in my grade, was a big achievement in itself. Once I got to Deloitte and I started working for a lot of investment banks, hedge funds, real estate syndications, I was seeing how rich and wealthy people were becoming even more rich and wealthy. I mean, some of these guys were taking 15-year interest-only balloon debt notes and just refinancing after 10 or 11 years. I'm just sitting there, how are they able to do that? The everyday person's not able to do that. And it was kind of a combination of that with the passion of wanting not to help everybody, but I wanted to help that person in their family that wanted to change their family tree. Not just help every single person, but the person in their family that was going to be that person to change their family tree. And so admittedly, while I was at Deloitte, I started my own firm on the side. And then it got to the point where I had enough social proof through content and through, enough clients that I could eventually leave Deloitte and then start run my own CPA firm full time. As far as how I've gotten to become known, it all started with giving value. So when I originally started, I found just these real estate Facebook groups and tons of people lurking in these groups that were absolutely clueless when it came to taxes, financial statements, etc. And so what I did was I put a timer on my phone, 15, 20 minutes every day. I would just respond to people's questions. I would join the local realtor Facebook group. I joined the short-term rental group. I joined every single group, just started responding to people's questions. And you do that enough, and it got to the point where people would start tagging me in the post because they knew that I would know the answer. And that's kind of how I got connected with Bill Faith and his group. And when I had joined that group, there was about 3,500 members in it, which now has almost, last time I checked, was about 24,000 people. So in a matter of a little over a year, that group has 8x in size, and it has grown. Our persona and our business is exponentially, whatever the word is. But it all started from giving value. And so when I gave value, actually Bill reached out. He goes, "Hey, there's nobody else in this group that's like you. You're not pitching services, you're not selling a course, you're just literally just giving value, leaving it on the table, and then walking away. That's the best thing that you can do." And then it got to a point where he invited me to speak to his mastermind group, which at the time had about 35 to 40 people in it. Did a Zoom webinar live. This was probably early May 2021. And then he goes, "Hey, I want you to come speak at my boot camp in Nashville, October 2021. Did that, killed it. He goes, "Hey, I'm doing an event in Gulf Shores in January. You want to come speak there?" Did that, killed it. And then that's when at that point in Gulf Shores, he goes, "Hey, I'm hosting a conference with 850 people in Nashville that me and you were both at, Patrick." He goes, "Do you want to speak there?" And I said, "Absolutely." And so it all geared up from there, and just providing as much value as I could to the space and not ever asking anything in return. And I think that's the same way in business. Is if you give value without ever asking anything in return, you're going to get multiple of what you can actually handle. There's a lot of theories and principles around this, and the Bible even actually talks about that too, about giving more than you take. And that's really how I got started and known in the space.
That's an awesome story. And I have like a million questions, but let's start with this one. Religion is a big thing in your life. Can you maybe talk a little bit about how that prepared you to be this very giving person and giving back with content, and how those principles really guide you in your life?
Yeah. So there's a story in the Bible with parables. And so essentially, God gave these three different people different amounts of talents and opportunities. And, so some guy got one guy got three, one guy got five. And it's the person who can manage it the best is going to get more responsibility, more opportunity, essentially. And so that was my call to action. Is I learned how to manage money before I even had money. Even when I was still like in school, dad, I was negative $30,000-$40,000 net worth. I was learning how to manage money before I even had money. So that way, once I did have money, I knew how to multiply it and be fruitful with money and be able to give and be able to bless other people. And so I knew what to do with the money before I even had the money. And I think that was huge for me, starting off the salary coming out of school, and, now 4 or 5xing my income. I've been able to do that at a larger scale and be able to bless a lot of people.
Yeah. You also mentioned that you were the youngest person in Illinois to get their CPA license.
Yes, the way I was able to do that. So in Illinois, we have a 150-hour credit rule and a 1-year work experience. And so to be able to get 150 credits is normally 5 years worth of schooling. So traditionally people will do 4-year degree and then a 5th-year master program. But that's not enough. Then on top of that, they need a year of work experience. And I was able to get 5 years of school done in about 3.5 years because I was taking summer classes, doing internships, getting six classes a semester, getting everything that I could to get done. So I was able to, graduate college basically a 1.5 years early and get that work experience at the same time, which allowed me to get my license right before I turned 22.
That's awesome.
Which at the time, to my knowledge, again, was the youngest person to do it. I called the lady. I just wanted to verify it.
Maybe we got to fact check you on that one.
Yeah, we need to.
Dude, does Ryan still hold the record for youngest person in Illinois to get their CPA? Whoever wants to fact check that, go for it.
To be able to get it though, to get your license in itself is an accomplishment, but to be able to do it pretty young is also cool too. Most people, the last time I looked into it, most people get their license about age 29 or 30. And that the reason why that is most of the time in public accounting, in order to get to that next level of a role, you have to be a manager. And in order to be a manager, you normally have to be a CPA. That's why I think that's the normal age is 29 to 30.
Got it. Interesting. now you got your CPA. You've been helping a bunch of people in the group. Why should people trust you? You're 24. You don't have as much life experience as somebody that has 30 plus years. How did you convince people to trust in your judgment and in your knowledge when you're comparing yourself to people that have been in the industry for so long and have seen everything?
Yeah, I think it's because I'm an investor too. A lot of CPAs aren't, and also real estate investors. So I know what to look for, and I know the types of strategies that people are wanting to do. I mean, I can't tell you how many times I've seen people's pro formas or even their year-end P&L, and I'm sitting there, hey, where's your mortgage insurance? Where is your property taxes? Where is your utility bill here? I don't see this anywhere. Oh, you have a line that says mortgage payment. Well, that needs to be broken out between taxes, interest, insurance. Some of the things that as a CPA you may not catch because you're not in the weeds of real estate investing, right? The amount of time that it takes to do a rehab, what goes into a rehab and staging. You can know by the breadth of work, somebody's rehab, how much it should cost. And you're able to pick things out. Hey, I think you're missing some things here, or I don't think you had enough. Where's everything at? And being able to combine being an investor as well as a CPA, I think is what has built a lot of trust.
That's great. Let's talk about the investing side of things. When did you get your first property? What was it? How did that investing journey kind of funnel you into what you do now?
Yeah, I got my first one 22. I did just a house hack, normal house hack, like most people get started. If I could go back in time, I actually would run that back a little bit differently. I would have, instead of doing a FHA loan, which is just the bare minimum, you just need a year of work experience. You could have a very shitty credit score and still get an FHA. 3.5% down. I would have done a 5% conventional loan. And the reason why is because if you have an FHA loan and you get 20% equity, that's when you're able to drop off the private mortgage insurance. But in order to do that, you need to go hire an appraiser and you need to refinance your loan with the bank. If you do conventional 5%, as soon as you hit 20%, all you need is the appraisal. And then you could tell the bank, hey, I have 20% equity, drop the PMI, and they'll do it automatically. So that was one of the mistakes that I made when I first started. Was I had really good credit score and good income. I didn't need to go FHA, but at the time, that's what everybody was talking about, using FHA, 3.5% down to get your first property, which again, it's a great idea and strategy. But if I could go back, I would have just put the 5% down. So then when I went to refinance, I didn't have to pay closing costs, refinance costs.
That
So
makes sense.
yeah, it started from there, and then I ended up doing a triplex in Maryland as another investment, and then an Airbnb in Ohio. And those have worked well so far. But what I've realized is that even though you can get a really good cash on cash return at those price points, 250, 300, 350K price point, your cash flow in retrospect isn't as high for the amount of work that you're putting in, because it's almost identical the amount of work for an $800,000 property as it is a $400,000 property, or $1 million property compared to a $500,000 property. There's a fixed cost in there. That's your time, that the due diligence time, the closing time, setting up the property time. There's a fixed amount of cost of your time in there. And once you realize that, you start to go bigger, right? And for me, that was, hey, going from a $400,000 house to a $3.5 million campground that I'm currently doing. And because I realized that my time and energy put into the deal, yeah, I'm getting really good cash on cash returns, but I'm not getting as much cash flow as I want. And so knowing that you can increase your cash flow by getting a bigger deal. Your cash on cash may not be the same, but your cash flow is going to be greater the bigger the amount of property you're playing with. And that's what I'm working on now, is a $3.5 million campground in Branson, Missouri. And then from there stemmed another campground deal that I'm hopefully getting into, which is in Colorado. So I'd be happy to share some more information when I get that.
That's to be determined. So this campground, thinking bigger, I totally agree with you. When it comes to the energy to actually take on a deal like a hotel versus a short-term rental, it's interesting because the hotel takes almost the amount of work similarly to a short-term rental. right?
Mm-hmm.
Why not just do bigger deals when you have the chance to do that? So I totally agree with you on thinking bigger. A lot of people think too small, and they really don't think that they can achieve what they need to achieve at, let's say, oh, I'm 25. I can't take on a hotel deal. I can't do a $3.5 million campground. But what the interesting thing is a lot of times just finding the resources to make it happen.
Right, right.
Yeah.
And
So
I think that goes a little bit more into the mindset, especially at a young age to be able to do those types of things. A lot of people are already looking at you saying there's no possible way, so and so could buy a house. And if you're young listening to this, you're going to get the same comments from friends, family, all these limiting beliefs. But you have to understand that everything's internal, right? It's only if you allow those limiting outside beliefs from friends and family to influence your behavior, that's really what's going to hurt you. If you believe in yourself and you know that you can do that because you've seen other people your age do it, or you've met people online. I think that was the biggest thing for me was nobody in my friend group was buying real estate or even investing in the stock market or retirement. Nobody was doing that. And so I had to get myself out of that, let's call it a fishbowl, right? A goldfish can only expand to the size of the fishbowl. You got to put it in a fish tank instead. Getting into those new circles where you're seeing people that are your age or a little bit older doing these deals, I think it changes your mindset. And that's a really big thing for people who are trying to get their first deal. Because if you ask friends and family who have been W-2 employees for 30 years and never owned a business, never owned rental real estate, they're not going to know what to do.
yeah, and it's interesting because that came up in the Facebook group, that's Chair Nation Facebook group.
Oh yeah.
And I know you chimed in on that, but a member was having issues with people in his family, I believe, were discouraging him from investing and saying it was a dumb idea and can you make money? And it's hilarious because the comments just got filled with people just totally disputing all of those. It's a belief at the end of the day. It's not fact. And they're basically disputing that those are not true facts and that people have done it and it's possible. A lot of times it's just changing your environment can have such a big impact on the person you become. And I think that's why a lot of people our age don't start investing in real estate until they're older, is they're around everybody else that's just all about getting into the big four, right? Or all about even lower end, all about just playing video games and just chasing women and doing whatever other crap that young guys want to do. It's like me and you are both in committed relationships, right? We're focused on real estate. We're around other people that are doing real estate. When you're around those kind of people, it's hard not to continue doing what you do. And it's just also just leveling up your circle all the time. And it's interesting, it's because the first time I met you, Ryan, you were just on the upswing of getting followers. I think you had like 500 or 1,000 followers at the time on Instagram. That's how I measure your growth. Now you have, I don't even know, it's over 10,000 for sure. And that's all organic growth. That's not buying any followers. That's none of that. And Ryan and I talked about that. A lot of people buy followers and it looks like they're a lot bigger than they actually are. Ryan actually gave value to people and people decided to follow him because of the immense outsized value that he gave them, right? And that's just the interesting thing. Yeah,
you made me think of a quote there. I saw this one time. It says, you can't change the people around you, but you can change the people around you. And I first read it, I was like, wait a minute, hold on a sec. I had to think about it, but it's true. I have the same problem with some of my friends, just even to get them to do the baby steps of investing in a Roth IRA or something else. I have one friend that's been asking me for 2-3 years, oh, is now the right time to buy? I'm like, dude, you're going to ask the same question next year, aren't you? Yeah, you can't change the people around you, but you can change the people around you, the environment that you're in, that you put yourself in, like you said.
100%. So let's dive in. Why, we both got into short-term rentals. Why did you go into short-term rentals, and what are the tax incentives when it comes to short-term rentals? Let's dive into taxes.
With any rental real estate, you get a host of ways to make money. And I have calculators that really break this down, but there's really four pillars of how you can make money. The first one's going to be cash flow, right? Net cash flow, or people will call it cash on cash return. It's the amount of cash flow that hits your bank account after all expenses are paid. Repairs, maintenance, utilities, the mortgage payment, everything. You have cash flow. And most people will try to hit at least 20% or more. Some of the deals that we've done, we've had 50, 60% cash on cash return investment of our money. The second pillar is that equity pay down. So you have a return based on the amount of equity that's being paid down by your tenant or your guest, which normally can be between 6 to 8, maybe 10% a year. Third pillar, you're going to have your appreciation. Appreciation is just the value of the real estate going up over time. Typically, you'll see anywhere between 2 to 3% appreciation per annum. In these last couple of years, it's been absolutely insane. And if you've owned a property in the Smokies, you know exactly what I'm talking about, where it has literally made people millionaires within a matter of 3 years. I have a client that bought 2 of them in 2018, 2019. I mean, this is a guy that never made more than 100 grand W-2, got his hands on a few cabins in 2018, and now he's a millionaire just based off 2 purchases that have gone up from 280 grand each to now the cabins are worth close to $1 million. It's absolutely insane how many millionaires real estate investing has made within the last few years. So that's number 3, appreciation. Lastly is the tax benefit side of it. If I'm able to save 32% off my marginal tax bracket, those savings are tremendous. And you add all those up. I was just playing around with the calculator that I had for this duplex that I bought, and I was getting a 250% return on my money per year. It was crazy. When you factor in, again, the cash flow, the equity paid on, the appreciation, how much it's gone up in value, and then those tax benefits, you're not going to get 250% appreciation in the stock market unless you're able to pick the right stocks. Whereas real estate is, hey, if you buy it within the right area, if you're doing long-term rentals or multifamily, there's good job growth there. There's people who are wanting to come to that city. You're going to get appreciation. As long as you don't buy a property next to like a dump truck plant or something like a nitroglycerin plant, your property is going to go up in value. And it's those 4 pillars that make real estate such a more better investment than the stock market. But to tackle on tax benefits, you have right away, any dollar that you make in real estate is taxed more favorably than if you were to make it at your day job. And when I normally present this, I'll show 2 slides and I'll show, hey, here's how money gets taxed at your day job. At the highest rates, you have to pay this thing called Social Security Medicare tax on it. You're paying taxes up to 37%. Whereas in real estate, you're able to offset a lot of the income with some of the expenses that you just have to pay out of pocket. Your property taxes, interest, insurance, repairs, maintenance, you're able to offset your income with those expenses that go towards increasing the value of the property, which is insane to think. Next thing, you don't have the Social Security Medicare tax. So immediately, every dollar that you earn in real estate, rental income wise, is going to be taxed better than if you were to show up to work. And lastly, when you do decide to exit, if you do sell it outright, the max you're going to get hit with is a 20% capital gains tax compared to 37% tax that you might pay at your day job. My mantra and what I really teach my students, clients, people who follow my content is you need to take the income from that earned bucket, whatever your day job is, and convert it to vehicles that are taxed a lot less, like portfolio income through the stock market or passive income through real estate.
When it comes to short-term rentals, why are short-term rentals so beneficial for people that have W-2 jobs?
Yeah, to understand that, you have to understand the history of the tax code. Before 1986, it was all the income was considered one. So all your income just got all lumped into one bucket and they said, hey, here's your total income. What that created was a tax shelter for a lot of rich and wealthy people because they were able to be a lawyer or a doctor, make $500,000, $1 million a year. And as long as they had enough rental losses, they would be able to offset their W-2 or their business income. What happened was Congress put a stop to this by saying, hey, there's 2 buckets of income now. You're going to have what's called non-passive income, and you're going to have what's called passive income. So 2 different buckets. A couple years after that, realtors and people in the real estate field got really upset because they're like, hey, wait a minute. If a doctor has a business income and he has another business that has a loss, he's able to offset those. But let's say I fix and flip full time and I have rentals. I'm not able to offset those 2. And so that's when real estate professional status came about, where if you're a full-time realtor, real estate agent, property manager, you're able to do your day job, fix and flip, wholesale, whatever it is in real estate, invest in the rentals separately and use the losses from the rentals to offset the income from your day job. That's real estate professional status, but that only applies to long-term rentals and multifamily real estate syndications. The reason why short-term rentals are the most beneficial from a tax perspective is you don't have to be a real estate professional. You don't have to work in real estate in order to take the short-term rental losses against your W-2 or your business income. You just have to prove that your average guest stays 7 days or less and that you do what's called materially participate in your property. If I wanted to be a real estate professional, I would have to say, hey, Ryan worked 2,000 hours a year at his CPA firm and he worked 2,001 hours in real estate. It's not going to happen. I work 80-hour weeks sometimes, but not every single week out of the year. And the government knows this. Whereas short-term rentals, it's a lot lower threshold. And it could potentially be that you only have to work 100 hours in your short-term rental as opposed to the real estate professional status requirements. It's very beneficial for high W-2 earners, tech earners, doctors, lawyers. I even have other CPAs as clients of mine to invest into short-term rentals and use those tax losses to offset their W-2.
Have you taken advantage of this?
So I don't manage my own properties, unfortunately. I should practice what I preach, but I found out that my time is better spent focused on my business and my content in the 3 businesses that I run rather than managing the properties myself. Because as an investor, I don't really want to be involved in the day-to-day operations of my properties. I'd much rather pay that co-host or that management fee to be able to step out of my property. So me personally, I don't practice what I preach there. Not yet, until the right deal comes along, or maybe next year we might have to revisit.
Well, maybe it's more worth it for you to work actively in something else. How do people understand, is it really worth it to actively participate in my property, or should I just focus on my job? How do you really make that distinction?
Yeah, that's a great question. So I'll say this. I have a calculator that does just that. It's on my website. We can link it in the show notes. You'll type in your purchase price of the property, do a pro forma, and then plug in some of your auxiliary information like your W-2, your other rental income, and it'll actually tell you what your tax benefits are projected to be. Then you're going to take that number, let's call it 25 grand. Is it worth you managing your property for an extra 25,000? That's going to be up to you. For the person who's making $1 million a year, they're probably like, maybe not. But if you're that person that has a $200,000 W-2 income and you're like, hey, I can get an extra 25,000 if I self-manage. Not to mention, if you don't self-manage, you're going to have to pay a management fee. So you take that management fee plus that 25 grand in savings, and then you'll see if it's worth it or not. We do this for prospective clients anyway. We'll tell them, hey, this is what we think you could save. Then you decide if it's worth that effort to go in to self-manage all your properties. As far as what are some of the key things to look at to make it worthwhile is our ideal client or ideal investor is going to want to be in a high tax bracket. It's going to be somebody that's 24% marginal plus, maybe 32, 35. If you're single, making more than, I would say 150, 170, or if you're married, making more than 250, 300, you check that box, high marginal tax bracket. The next step is going to be, you're going to want a higher purchase price. If you couple your high W-2 income with a decent sized purchase price, let's call it 450 or more, 400 or more, you're going to check those 2 boxes, right? And the more you can check boxes, the better your situation is going to be. So you couple the high W-2 with a high purchase price with a want to actually self-manage the property, and the potential tax benefits go up.
Let's say that you don't want to actively participate in your property. What can somebody like that do to offset their income? Is there any other tax benefits that real estate gives to people that don't want to actively participate?
There are benefits to investing in real estate, even if you are not self-managing. And one of those is that all your rental income is classified as what's called passive, which means if you have losses from one activity, you can use those to offset income from another. And I use this example when I spoke in Vegas of showing, hey, here's my 2 long-term rentals that had income or profit. Here's a laundromat that had income or profit. And here's a short-term rental that I generated a loss on, that I was able to use that loss to offset my other income. I see this all the time with clients. They'll have 2, 3, 4 long-term rentals. They'll say, to hell with this, the cash flow sucks. Invest in a short-term rental. Even if they're able to accelerate the depreciation on the short-term rental, even if they don't self-manage, they're still able to use that loss against other rental income. And that's ideally where all of our end goal should be, is all of our income comes from that passive bucket. And we're able to just do a quick calculation. Hey, I got $250,000 a year of passive income coming in. If I don't want to pay any taxes on it, how much real estate do I need to buy in order to offset the $250,000? That's the model that I lay out for a lot of clients, but that's eventually going to be just a quick calculation. Hey, how much net rental income am I going to have this year? Okay, how much do I need to buy in order to offset that?
That's great. Talk a little bit about how rich people build wealth through real estate and taxes.
Yeah. So in tax, you have a thing called an ascension to wealth, which is basically anytime you wake up with more money than you had the day before, you typically had to pay tax on that, right? If I wake up with 10 grand in my account versus 0 the day before, where did the 10 grand come from? I'm assuming it's not a gift from anybody, because gifts are not taxed, but that 10 grand is going to get taxed unless you do it in an activity that the government incentivizes you to do, whether that's business ownership, real estate ownership, or investment income. One of the biggest things out there right now for homeowners is, hey, if you live in your property for at least 2 years, you're able to sell it pretty much tax-free, up to a certain extent, unless you live in California and the appreciation is just sky high. But there's incentives out there, such as you have this thing called the 1031 exchange, where you're able to defer the capital gain on your sale into a future year. It's really, the wealthy people realize, as long as we put our money in these pillars and these assets that the government incentivizes us to do, business ownership, investments, real estate, we're going to get favorable tax treatment. At that point, it's all about increasing the amount of cash that hits your bank account, ascension to wealth, but doing it so in activities that aren't going to get taxed as high. So what happens is your cash that hits your bank account is going to double, triple, quadruple over time, but your effective tax rate, the amount of tax that you pay on each dollar earned, is going to go down. This is why that quote where Warren Buffett says that he pays less in taxes than his secretary, it's true to some extent. He pays more taxes than his secretary does, of course, but the amount of taxes that he pays in correlation to his income that he earns or makes is less than his secretary's. His effective tax rate is less than his secretary's effective tax rate.
Wow. Is there really any benefit to being a W-2 employee from a tax incentive?
I mean, you got to make money somehow, right? It all starts with the income producing activity. This is not a call to put your W-2 and be an entrepreneur full time, but it all starts somewhere. One of the incentives I would say for being a W-2 as opposed to 1099, let's take a real estate agent, for example. Not a lot of them are W-2, but some of them are. Well, if you're a W-2, you only have to pay half of the Social Security Medicare tax because your employer covers the other half. If you're self-employed full-time, well, congratulations, you get to pay both halves of that self-employment tax. Being self-employed is a lot harder to qualify for loans compared to a W-2. And I'm sure you've experienced this, because I definitely have, of leaving your stable W-2 job where the payroll is consistent to your income fluctuating. Maybe I make 10 grand this month or 20 grand the next month or 15 or whatever. The bank, your lender wants to see a consistent income. If you're self-employed, it's very hard to prove that. You typically need 2 years of tax returns and bank statements in order to qualify to buy a property under a conventional loan. If you're a W-2, they just want to see that you've been working in that space for a little over a year and then your income is consistent. And there you go, you have a house. There are a lot of perks and benefits of being a W-2, especially when it comes to financing and loans. That's why I will always tell people is if you're thinking about doing entrepreneurship or real estate full time, go get that last house while you're at a W-2. Close on the house, make sure everything is good, and then bounce. Use your W-2 to your advantage, because you're going to get better terms, better rates, better financing as a W-2 employee than you would as a self-employed borrower. And that's just the truth.
Yeah, 100%. Why is real estate professional status such an amazing benefit to real estate investors? How can people take advantage of that from a tax perspective?
With the real estate professional status, it really is the golden goose egg of the tax code, is what I like to call it, because If you're full-time in real estate, so that's going to be your realtors, fix and flippers, wholesalers, property managers, even sometimes construction, you're able to say, here's my income that I'm making. Let's call it $250,000. As long as I buy these rental properties that are going to generate me $250,000 in depreciation, I'm able to wipe out my entire tax liability for the year. So a single person making $250,000 is probably going to pay $70,000 to $80,000 in taxes. If they're able to invest in enough real estate, they're able to offset their tax bill completely. And with real estate professional status, one of my biggest clients is probably fixing and flipping 7 to 8 homes a month. What they're doing is, okay, we're fixing and flipping these homes, but we need to pick out just enough homes that we actually make rentals that we're able to use the losses from the rentals to offset the fix and flip income. It becomes this more of a strategy to, again, boost your net worth on paper, but pay less in taxes. Real estate professional status is the key for somebody who's full-time in real estate. Most of the time, it's mostly agents that will qualify, but there's 11 different types of activities that actually count. But eventually, it's what I'm going to be looking to do full-time. Unfortunately, being a CPA doesn't count as a real estate professional, although attorneys do somehow. I don't know. But yeah, real estate attorneys sometimes qualify, but real estate CPAs don't. I don't know.
That's interesting.
But that's essentially what I'm looking to do at some later point, is just be a real estate professional full time.
Perfect. So how do you qualify for that, more or less?
Yeah, so there's really 2 qualification tests, and then I would call it a material participation test. Number 1 is you have to spend 750 hours in a real property trade or business. So again, there's 11 different types that qualify. But let's say I'm a realtor, I work 750 hours. But the other key part of it is it has to be more than half your working time. And it's the second piece that kicks your average Joe out of being a real estate professional, because let's say I work 1,500 hours at my tech job as a W-2, I'd have to spend 1,501 hours in real estate to overcome that need to spend more than half of my working time in real estate. There's only been one guy in the history of the entire case law that had a W-2 in a non-real estate field and has been able to qualify as a real estate professional. You check those 2 boxes, you still have to self-manage your properties, unfortunately. It gets a little interesting with what you're able to do as far as, hey, I'm able to manage some properties, but not all of my properties, and group in some of my property and group in all of my properties. I've explained it to this guy at a conference where I'm like, hey, just go manage the 5 or 6 properties by your house, get your 500 hours of material participation, and then you're able to group in some of the properties that you have with property managers or even real estate syndication losses. You're able to group those in together. Real estate professional status is not going to work for somebody who has a W-2 in a non-real estate field.
Yeah, I can see that. A lot of times people that are in real estate professional status, they travel the country and visit different properties and take vacation. How do people that can travel to Hawaii and look at real estate and do real estate related activities there and then sit on the beach for half the day? How does that all work with real estate professional status? There's a lot of people out there that want to travel the world and do real estate and get tax write-offs for traveling.
Whether or not you're a real estate professional, you're still able to deduct some of your travel costs. The big thing when it comes to deducting travel costs is it ordinary and necessary in the course of business? So if I take my family on vacation to Hawaii and I decide to whip out my laptop and I do some work while I'm in Hawaii, that does not count because I was already going there for vacation. It just so happened that I whipped my laptop out and maybe I checked out a few homes while I was there. But if you have a business to say, hey, I'm going to Hawaii to look at homes, I'm bringing my family along with me to check out some potential investments, then you might have a good case. As far as being able to deduct the cost, what they don't tell you is that you actually have to be in the course of business at that location. So for example, if I live in Illinois and my first investment is in the Smoky Mountains, Tennessee, I have to close on that property in order to be able to deduct the travel costs there. Very interesting. Now, let's say I have a cabin in the Smokies and I go to visit another property in the Smokies. Well, because I've already established business purpose there, I'm able to deduct those costs regardless if I close on that second property. Interesting, right?
I never knew that. So
yeah,
personally, if I go and visit and check out a hotel deal in Michigan and I don't close on it, that's not deductible.
Correct. If you've not already established business purpose in Michigan. Now, in this day and age with us where we might run multiple businesses at one time, right? I have a CPA firm business, I have a content course creation business, and I have a syndication business. I should be able to find a way to deduct that under one of those three businesses. But yeah, that is the truth. And not a lot of people will tell you that because everybody thinks that everything's a write-off. But if you're not in that business, in that area, they're not going to allow you to deduct it from your taxes. If that was the case, everybody would just go, while they're on vacation, they would just go call up a realtor and ask to see a house and then be able to write their whole vacation off.
Yeah, that would not work. There's a lot of TikTok reels, quick videos that people make of, oh, I'm traveling the world for free because of tax incentives, or I'm not paying for any food because of tax incentives, or get into real estate because look at this car that I have. I wrote this car off and I got it for free. How to get your car for free? Do this. And so what do you think about all of these? What are some of the misconceptions that you see? I think that would be honestly very interesting, Ryan, for you even just to do some reacts to people's videos.
I know, I need to start. Yeah, a lot of it is clickbaity. And there used to be a saying in journalism that said, if it bleeds, it leads. And it's the same thing with a lot of the clickbait stuff that you see nowadays, especially related to real estate. And, oh, how did I buy this house for free? Or, oh, this house gave me 100% cash on cash return. Or a lot of it's clickbait type of stuff. And you have to dive deeper into what it actually means. So for example, when I explain people how deductions work, I always say that it is not free. Instead, it's the government giving you a coupon to go invest in those types of activities. So if I'm in a 35% tax bracket, it's just like me getting a 35% coupon to go to Kohl's or Sears or JCPenney. If I have $1,000 business expense, I'm able to write off that $1,000, and at a 35% tax bracket, it saves me $350 that year in taxes. So the game then is to get the write-offs that actually make sense, that are going to accelerate your business, not the ones that are just like a one and done, and it's not really going to invest into marketing, invest into employees and ownership. If a car is going to make you money, then sure, go ahead and do it. But the most common thing that I see, especially with realtors, is realtors will go make 100, 120 grand and go spend 50 or 60 on a car. That's absolutely insane. When would you ever want to do that? Spend half of your money on a freaking vehicle. And if you're offended, it's probably because it's true. Realtors are the most common known to do this. It just does not make sense to me because, yeah, you need a car to go toy around and show houses, but do you need a car that's half of your salary that you just made? Probably not.
It's funny you say that because realtors are notorious for spending, not investing in real estate, but spending it on cars and watches and purses and I don't know, all sorts of things. And you get like selling sunset, and it's building that culture of, oh, like you got to look a certain way. And it's funny because a lot of real estate investors don't do that. It's funny because everyone that from the outside looking in looks at real estate. Oh, I know somebody that's in real estate. Are they a real estate agent? Yeah. It's like, okay, well, there's a difference from what I do versus what they do. I'm a real estate investor. And not to say that there aren't realtors out there that are really good with their money and they invested. It's just this culture that we see with all these memes about realtors buying things they don't need. It's crazy.
That's interesting that you bring that up. One of the meetings that I went to over here by my house, I went with one of my mentors who's much older. He goes, look into this room. You see the people that are wearing suits and flashy watches and nice shoes and like Balenciaga stuff. Those are the guys that are like wannabes investors. You want to go talk to the guys that show up in jeans and work boots. And I'm like, what? And he goes, yeah. He goes, just to go talk to them. And then it's like, I picked out 3 guys that had work boots on and 3 guys that had the suits and stuff. Most of the time it was the guys in the suits that, hey, I want to get into this space. I want to start doing apartments. I want to start doing this. Talk to the guys in the work boots. They're like, yeah, I own $1 million a year plumbing company and I buy about 15 properties a year. Oh my gosh, he's so right.
So this is a tip from Ryan and I now. Whenever you go into a real estate meetup, always target the people in the work boots and the people that look kind of like us. I'm just wearing this like t-shirt, nothing crazy fancy. I'm wearing sweats actually, but I'm not going to show that. But look, Ryan's wearing, I mean, for the people that are listening, we probably can't see this, but Ryan's just wearing a black tee.
$6 t-shirt.
$6 t-shirt. That's what it is. You got to save your money somehow. That's funny. going back to what we were saying earlier about the people that flex about their cars and all the things when it comes to taxes, is that really the smart way of, I don't know, do you think that an unnecessary expense just for tax reasons is a smart move for somebody that's getting started out?
No. And the reason why is because you're probably in a lower tax bracket to begin with. Somebody wanting to finance a $50,000 car, if they're in a 37% tax bracket, it's a lot more worthwhile to do that because you're saving 50,000 times 37%. You're saving grand by doing that, by buying that car. Versus somebody who, especially if they're just getting started off or they quit their W-2 to do real estate, they might be in a 12 or a 22% tax bracket. Not as beneficial at those lower tax brackets to want to finance or purchase stuff in the name of a business or real estate than it is if you're at one of those top tier brackets. That's another thing where it really is specific to the individual's case. Another thing that I do see a lot of realtors make this mistake of, and it's especially when they're first starting out, is they're told and they're trained to write off everything. They're told to write off everything. So they might be making $80,000, $100,000 a year selling real estate, but they have $60,000 or $80,000 for write-offs. You made $80,000, but you just spent $50,000 on shit you didn't need. Now your income is 30 grand. Good luck going to a bank that will sell you a house if you only make 30 grand a year. The key is you want to spend money on things that the bank will add back for tax purposes, like depreciated assets, like a house that will depreciate, show up on your tax return, but you get to add that back. Like retirement contributions, like health insurance, things that you're able to expense, but they add that back to your income for tax purposes. So I see, especially a lot of entrepreneurs starting off, they want to write off everything, but it could be a very big mistake. Again, picking on realtors today, but especially realtors, they won't want to write it all off, but then they go to the bank to qualify for a loan and they say, hey, you didn't make any money here. Look at your profit and loss.
Let's talk about the balance between showing a lot of a loss versus showing income when it comes to qualifying for assets.
Yeah, I think when you're first starting off and you're building, whether it's your business or you're building your real estate portfolio, when you're first starting off, you don't want to write off as much as you do when you're in those higher tax brackets. So I'll give you an example. If I'm a first year entrepreneur, I might fall in that 12 to 22% tax bracket. I'm not really trying to get all the write-offs or the expenses in my business, especially the ones that are going to hurt me when it comes to financing qualifications. I would much rather spend less money when I'm starting off, be more conservative. And then once you've established yourself, your business, you've bought a few houses, now you're in that 37, 35% tax bracket. Then it's like, okay, let's write off a lot of stuff here because we want to lower our tax bracket. But there is a fine balance between, especially when you're first starting off to when your income's super high and you're more established. Depending on what side of the pendulum you're on, that's gonna be your strategy.
Yeah, 100%. Let's go into the last part of the show. And honestly, Ryan, you always drop bombs, man. I think I'm gonna have to have you on again. I haven't made a promise to anybody yet, but I'm looking at the time and I'm just like, oh man, I could go on for another 2-3 hours, honestly. So let's just leave a little bit on the table and give a little teaser. If you want to check out some of Ryan's content, where can people reach you?
Yeah, the best way is on Instagram or TikTok. It's just going to be at Learn Like a CPA. Also, I have a Facebook group called Tax Strategies for Real Estate Investors. That's almost at 4,000 members in there. If you want to check out my website with my blog and some of my free tools that I mentioned earlier, that's going to be learnlikeacpa.com. And if you message me, I should respond within the day. I'm normally pretty quick to respond.
Definitely reach out to Ryan. Look at his content because there's a lot of stuff when it comes to taxes. Ryan just spoke at the conference and he said he couldn't fit everything that he wanted to say in that 40-minute time slot. It's just crazy. And so there's just so much to the tax code. And Ryan does really make a big effort to make it as interesting as like humanly possible. I think he does a pretty good job to make it entertaining, but also simplified enough to really understand it. That's amazing that you can do that. What book do you recommend people to read? It doesn't have to be tax related. It could be any kind of book that impacted your life.
Yeah, my favorite one is 7 Habits of Highly Effective People by Stephen Covey. I originally bought that book for 50 cents at a Goodwill near my school. It talks about the disciplines and the pillars that you could put in your life that are going to make you successful. The biggest habit that I had was habit number 2, which is begin with the end in mind. So begin with the end in mind is picturing yourself at the finish line, being able to work yourself back to where you are now to see the steps that you have to take to get there. Oh, so-and-so is the CFO of the Chicago Cubs. Well, how did he get there? Okay, well, he got an accounting degree. He got a CPA. He worked at a big 4 firm. Then he worked at a bigger firm. Then he became the assistant at the Cubs. Then he became the CFO. Like, what did he have to do? Begin with the end in mind and figure out what steps do I have to take to get to that next level. I think that's where you start investing in mentors, or you find yourself in some of these groups or these masterminds where it's, hey, so-and-so is making 150 grand a year off 2 short-term rentals. Let me pick his or her brain about that and see how I can get there. So habit number 2, begin with the end in mind.
That's great. So what's advice that you would give to people that are listening?
Don't wait to invest and wait. Whether that's just starting off with a Roth IRA in the stock market or real estate, there's never going to be a better time to invest than right now. And sure, rates are up and prices aren't coming down as much as we'd like to, but as long as you continually invest over the course of your life, what does it matter if you bought in at a higher price point? Because we all know in 20, 30 years, all the assets that we're buying are going to make us money and are going to build us wealth. So it doesn't necessarily matter the timing of when you do that. As long as you have a long time, the people who get burned are the people who are trying to sell quick. There's never a wrong time to buy real estate. There's only a wrong time to sell it. If you're distressed selling it, yeah, you're going to lose your shirt. You're going to lose profit. But as long as you can buy real estate, have the cash reserves to weather a storm, there's never a wrong time to buy, only a wrong time to sell.
For sure. So last one. What's next for Ryan? What is Ryan working on? How can people help you if they can? What's going on?
Yeah. So 2 things. Number 1 is I'm really interested in building up my content and course creation and doing more guest speaking and traveling events. If you have an event you want me to come speak at, just reach out to me. I'd be happy to look into it. If you want to do a podcast, I'm happy to jump on your podcast also. And look for more course material creation coming from me. That's on the business acumen side of things. Of course, we're still taking on new clients. I've beefed up my employee staff now to where we're able to service more clients. On the investing side, I'm looking to get into more of alternative investments. So campgrounds, RV parks, doing domes, glamping tents. Those assets have some of the highest cash on cash return. In a particular deal that I'm in now, on a $3.5 million purchase price, we're estimating over $1 million in gross revenue on a $3.5 million total cost. I just got sent a deal the other day, 100 and something unit apartment building, $10 million purchase price that was going to gross $1 million. So triple the price with the same gross revenue. It's really hard to beat these alternative investment classes right now.
So you're really focusing on cash flow right now. So focus on how can I get the most cash flow for my
Yeah, exactly. Let's say I can invest 25 grand and get a 12% cap rate. I'm using cap rate, but let's say I can get a 12% cap rate, or let's just say 30% cash on cash, right? I invest 25 grand, 50, let's call it 50 grand. I can get a 25% cash on cash, or I invest 100 grand or 150 grand and I could get a 20% cash on cash. It's the same amount of time almost, right? It's the same amount of energy, but in the second option where I'm investing more money, even though I have a lower cash on cash return, it's still more cash flow that's hitting my bank account at the end of the day.
100%.
Yeah.
And it's better, instead of doing 10 deals in Kentucky, let's say, or wherever, and getting 30% cash on cash on a $100,000 investment versus getting even 15% cash on cash on a multi-million-dollar investment. It's night and day because it's the amount of effort that it takes to do that deal. So that's
Right.
great. Awesome. Thanks, Ryan, once again, for just giving value to the community, constantly just giving value. And to this day, even after securing this spot of popularity, Ryan, that I've seen you achieve, and you're just still giving back and still just a warming heart, honestly. So thank you so much for everything you do in this community, man.
Yep.
I appreciate you so much. And as a friend, and I guess somebody that is in the space. So thank you so much for everything you do, man.
Yep. Thanks, everyone. Feel free to reach out.